Is ASML a potential opportunity? ASML is one of the biggest chip companies in the world. Super investors have bought into the business recently. Does that mean ASML is a potential opportunity? We'll perform an ASML stock analysis like Warren Buffett, one of the greatest investors of all time. Even though he's not invested in ASML, we'll reverse engineer his decision-making process to look at the most telling numbers before estimating not one but two fair intrinsic values for ASML stock. Along the way, there'll be a key bonus metric that just might be the tipping point when analyzing ASML for your stock portfolio. Then you'll want to watch till the end when we give our rating. But first, how has ASML stock performed? Right now, ASML trades for $608.54 per share. In the last year, their stock price is up 10%, which is just under the S&P 500. That's up 13%. Right now, ASML pays a 0.88% dividend yield that's added onto their gains in their stock price. In the last 5 years, it's a completely different story. ASML compounds at 29%. They're beating the market by a ton. That's the same in the last decade. They're compounding at 21% annually. Over this time, they're one of the best performing stocks in the entire market. When we go back all the way before the global financial crisis, in the last nearly 2 decades, ASML has compounded at 21% annually. They're one of the best performing stocks, with their stock price up more than 30 times. At today's prices, ASML trades $160 below its 52-week high. Still, they're up $200 from their 52-week low. How big is ASML? They're one of the largest chip companies in the world with a $238 billion market cap. But the burning question is, why should we be paying close attention to ASML? Founded in 1984 and based in the Netherlands, ASML is the market share leader in photolithography systems used in the manufacturing of semiconductors. Photolithography is the process in which a light source is used to expose circuit patterns from a photomask onto a semiconductor wafer. The latest technological advances in this segment allow chip makers to continually increase the number of transistors on the same area of silicon, with lithography historically representing a meaningful portion of the cost of making cutting-edge chips. Chip makers require next-gen EUV lithography tools to continue past the 5nm process node, which only ASML can provide. ASML's products are used at every major semiconductor manufacturer, including Intel, Samsung, and TSMC. ASML's machines can cost up to $400 million. Their installation base and the services provide give ASML perhaps one of the biggest moats in the entire world. Now with that understanding, let's dive into their numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A normal business earns 7% returns on capital. When we look for a benchmark that's double this, we can build in margin of safety based on the quality of the company. ASML's returns have more than doubled in a given year over this time. Things really skyrocketed for the business since 2020. They earned about 20% returns prior to then. In their last year, they earned 48% returns. When these are averaged out, ASML earns 30% returns in a given year. That's more than 4 times better than a normal business. This is a huge check on metric number 1. Metric number 2, we want to see growth to support their high returns. We're looking for growth in their revenues, earnings, and free cash flows. This is all or nothing. All 3 need to be up. In this time, ASML has more than doubled their revenues when we include today's numbers. Their earnings have also doubled, and that's the same for their free cash flows. It's not often you see a business with this level of growth across the board, especially one whose profits keep pace with their revenues. On average over this time, ASML has 50% gross margins and operating margins around 30%. That's pretty insane, and this is a huge check on metric number 2. Metric number 3, we'll look at the business like a single shareholder in the company would. We want to see earnings per share growth. We've learned they've more than doubled their earnings over this time. In the last 5 years, ASML has also bought back 7% of their shares. This increases the ownership percentage for existing shareholders in the business without them having to spend a dime. Their earnings per share are up even faster than their normal earnings. This is another check on metric number 3. ASML is perfect so far. Metric number 4, we want free cash flow per share growth. A very similar story here. ASML has more than doubled their free cash flows in this time. Plus, with their share buybacks, their free cash flows per share are up more than double. It's another check on metric number 4. In their last 3 years, ASML has produced more cash flow per share than earnings, which is something that not a lot of businesses do. It likely won't happen over the long run, but they convert a large percentage of their earnings to cash, which is great to see as a shareholder. ASML is still perfect through 4 metrics. Before we look at the strength of their financial position and get to our valuations, how about we check in on our bonus? Right now, ASML pays a 0.88% dividend yield, but is it safe, and do their dividends have room to grow? That's what we're trying to figure out as our bonus. We want their dividends to be supported by their free cash flows. This is the case in all of the last 5 years and today. ASML pays a modest percentage of their cash flows out as dividends. They easily support their dividend payouts. It's exactly what we want to see. This is another check on our bonus. In recessions, it's businesses with too much debt that can have the biggest losses or even go broke. Metric number 5, we want their net debt to be below the sum of their free cash flows in their last 5 fiscal years. ASML has had cash left over after paying off all their debts in each of the last 5 years. They ended last year with $3 billion in cash as their net debt. Today, they've spent some of this. They have $830 million in cash. This again is what's left over after paying these debts. In the last 5 years, ASML has earned $29.3 billion of cash flow. This is a very strong position to be in. ASML's finances look like they're in very healthy shape as they have this cash position and they generate a lot of free cash flow. This is another big check on metric number 5. They produced $7.7 billion in cash flow last year. Today, they produced $6.4 billion in their last 12 months. That's a lot of cash in a single year. Flawless through our first 5 metrics, does ASML have what it takes to go a perfect 6 for 6 on our analysis and be a select 6 stock? Why don't we find out? The big metric of them all, metric number 6, we want ASML's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 ways we'll estimate ASML's fair value based on their cash flows. Right now, they have a $236.5 billion enterprise value. They're one of the biggest chip companies in the world. We learned in their last 5 years, they produced $29.3 billion of cash flow. This means in an average year, they produce $5.9 billion in free cash flow. When we divide that by their enterprise value, it gives us a 2.5% average free cash flow to enterprise value yield. Currently, ASML produced $6.4 billion of cash flow in their last 12 months. When we divide that by their enterprise value, it gives us a 2.7% current free cash flow to enterprise value yield. These both come in below the risk premium we wanted and below the yield from the 10-year treasury. This means ASML's cash flow yield likely isn't attractive compared to the 10-year treasury. Coming in all the way on metric number 6, this is our first and only X of the day for ASML. Don't just throw this business out. You'll want to see our next valuation when we find out ASML's value per share. Then remember to watch till the end for our rating. Everything we've covered so far is important, but there's something missing that in my opinion is the main reason to analyze ASML. This takes us to using a discounted cash flow model to find out their fair value per share. A DCF model is like any model in any field, its outputs are sensitive to its inputs. We'll start with an average of ASML's cash flows in their last 3 years, then use historical assumptions to grow these into the future. Free cash flows can be lumpy year to year. This is why we take an average. It's up to you to figure out if these will be accurate or not for ASML. ASML has been a very predictable business in its past that better informs these assumptions, but it's no guarantee for the future. If we assume they grow their free cash flows 17% each year for the next 10 years, then in the next decade, let's assume this growth rate is cut in half and these grow at 8.5% annually. We'll add in ASML's tangible book value. This gives an estimate of their net worth. If we want a market-beating rate of return of 15% like Warren Buffett, at today's valuation multiples, an estimate of ASML's fair value per share is around $389. It's down a lot from today's current stock price, but it's just at their 52-week lows. So the company was trading here recently. Semiconductor stocks have been some of the best performing in the last decade. ASML as a major supplier has benefited from that. They perform very strongly as well. Semiconductors are a cyclical business. They'll have their ebbs and flows in the capital invested into their industry. We could see some of that in the future for ASML coming off of a very strong decade. Keep in mind, there's little doubt ASML is a great company. They are trading for a high valuation. In the last decade, they traded around 33 times earnings. Today, they trade around 31 times earnings. They also dropped to trading as low as 16 times earnings, which is just around the historical value for the S&P 500. So there were bigger mispricings in the company in the past. Keep in mind, because of this PE multiple, more than double the historical average of the market, ASML, as it keeps getting bigger and bigger, is likely to see that their growth slows down. There's the potential their multiple could re-rate, and this could be a headwind for future returns in the business. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before you make any investment decision. We've looked at ASML similar to how Warren Buffett would look at some of the numbers, but their numbers alone don't tell the full story. Buffett cares a lot more about the qualitative factors of a business. Those might be even more important for ASML. Let's learn what they are. Let's start with the long thesis. Number 1, ASML is the largest and most advanced firm in photolithography, an integral part of chip manufacturing, and is pioneering EUV lithography for the next wave of Moore's Law. Number 2, the extensive technical expertise needed to develop lithography tools, which are highly complex and play a critical role in enabling Moore's Law, serves as a major barrier to entry. Number 3, ASML has focused on operational efficiency in recent years to improve its profitability throughout industry cycles. But it's not all sunshine and roses. Let's look at a short thesis for the business. Number 1, ASML depends on a handful of powerful customers and sells high-priced tools that chipmakers strive to use as long as possible. Number 2, dependence on a limited number of suppliers for key components exposes ASML to possible disruptions in its supply chain. Number 3, the company's EUV lithography technology had been delayed and chipmakers utilized alternative solutions that use equipment from other vendors as a result. If future iterations of EUV face delays, ASML may lose share in the broader wafer fabrication equipment market. Now let's combine those qualitative factors with their numbers as we give our rating. So far in our analysis, we've learned ASML has a lot of the signs of being a wonderful business. They earn very high returns on capital, they've grown like a weed, they bought back shares, they have a cash position on their balance sheet, plus they generate a lot of free cash flow. They've also supported a growing dividend as a potential dividend growth stock. While they have a concentrated customer base, ASML provides a vital product for its customers that's very expensive and takes a lot to maintain, making them an integral partner with the companies they sell to. Our only knock on the business came when we looked at their yield compared to the 10-year treasury. That doesn't look that attractive right now. When we performed our discounted cash flow analysis, at today's valuations, if you believe those assumptions and you want a market-beating rate of return from your investment like Warren Buffett, an estimate of ASML's fair value per share is around $389, very slightly above their 52-week lows, but still within that range. When we combine their numbers with their qualitative factors, ASML is still a potential opportunity. They look like a great candidate for deeper research. If you enjoyed our ASML stock analysis, like the video, subscribe to the channel for more, and watch this next one.